Hello again and welcome. My name is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Wednesday, August 26, 2020. We have several topics of the day, what markets are paying attention to, so let's get right to them. Thanks for watching. So our first topic of the day are durable goods are surging. This is huge as it relates to the U.S. economy. In fact, well over 11% in the month of July, month over month. Why this is important? Well, if you've watched us for some time now, you know that we constantly refer to here at, when I say we're talking about Blanke Schein Wealth Management and our investment committee, we're paying attention to what markets are paying attention to. And that's high frequency data. Why that matters is it's real-time empirical evidence of that the U.S. economy, both here around the world too, is actually reopening, and people and consumers are going out there and purchasing things that are large items. Like we talked about real estate yesterday, and new home sales are surging. Today it's durable goods. Those are large purchases as well on the consumer side, such as autos. So if you think about that and you take out the airline purchases from that, this number is a record, once again, month over month. Last month it was a huge one too. So this is real-time empirical evidence that while we're reopening, the U.S. economy and all of us are learning to live with Corona on a go-forward basis. That's a new concept because the shutdown, as evidence that we just saw from March to May, while it did slow the spread, was really good for sort of slowing down the spread of this virus. It's not realistic on a go-forward basis because the economies have to go, because there's so many unintended consequences of the economic damage in the wake of this great pandemic. So this is more empirical evidence that we have imports surging, a lot of things moving around the globe, as well as in the United States. And so that's very important that we pay attention to these things because they're not taken lightly as it relates to markets. So these are all good items to pay attention to, that we're paying attention to as markets are too. So all eyes and ears are now going to be on Jackson Hole, Wyoming tomorrow morning. We might see markets in a real-time basis move off of Jerome Powell, the Federal Reserve Chairman's testimony, what he says, and oftentimes what he doesn't say. Ultimately, the Federal Reserve's mandate is a dual mandate. It's full employment for the U.S. economy, as well as keeping inflation in check. And inflation is going to be on the forefront and on the concern here as the Federal Reserve goes into yield curve control. By that is they're just manipulating interest rates, and what they've vowed to do in this time of need right now of economic sort of a recessionary period is keep interest rates artificially low for a long period of time. The question is it 2022, 2023? Well, their inflation target or average is the 2% mark. So we're going to watch and see what Federal Reserve Chairman happens to say as it relates to this. This will move the market. This might actually cause a market sell-off tomorrow, which would be much needed after what we've seen right now because we need some consolidation. We're seeing some sectors that are extremely lagging, like energy and financials, need to play catch up, and we need to see a rotation in when markets consolidate. So this could be the backdrop of how interest rates are playing out. And keep in mind, it's not that the Federal Reserve, these are all viable opportunities on a go-forward basis, because in the short term, the Fed is our friend and the trend is our friend. So any pullback in the markets are going to be opportunities for us at Blanke Schein Wealth Management. It's the concern going forward. It's not when the Fed has the punch bowl at the party, it's when the Federal Reserve comes in and turns out the lights and removes the punch bowl from the party. Okay, that's basically raising of interest rates, or increasing or taking away accommodations, if you will, or just slowing down the money supply, as they can often do. So ultimately, we saw this play out most recently in 2012 and 13 and 14. It was the Fed's temper tantrum. And we saw this heightened volatility in the market at that time. And markets just pulling back and didn't like the way the Federal Reserve handled it in our most recent history to prove that to the forefront. It's not right now. Right now, these are viable opportunities when the market pulls back, consolidation. We want to see that sector rotation because technology and a few others have run so quickly. And so that stretch needs to consolidate. But on a go-forward basis, what we're going to be concerned about as it relates to managing portfolios for our clients is, again, the Federal Reserve, what they say, what they don't say, but how they're going to lay out the next 12 months and 24 months. So let's pay attention to this and see what happens tomorrow. Our last topic of the day, and it's a personal finance tip. If you haven't done so already, start the refi process or inquire about refi. We have several people that we work with here at Blanke Schein Wealth Management that we can refer to you if you have any questions or thoughts about refinancing. But we're seeing a real estate boom. That means that the valuations are going to be there. Refinancing, here's what's happening. The government right now has just lowered interest rates, but they're also refinancing their treasuries, U.S. treasuries. Corporations are now calling all their bonds. We have a lot of fixed income that we manage at Blanke Schein Wealth Management, and on a daily basis, we're getting fixed income called. That means that those corporations are calling in their bonds, and they're now refinancing at lower interest rates. So if the government's doing it and corporate America is refinancing, we in retail America at your home is probably your most biggest asset in terms of, or at least liability. Time to refinance, and time is now. Markets have moved a little bit in the last 2 weeks in terms of 10-year treasury. We caught a bid. That means that rates have risen just a little bit. That's healthy for the U.S. economy. That's healthy for on the short term for stocks. But right now, that's also a signal that we could have seen the bottom in interest rates as it relates to the 10-year treasury. Again, no one really knows for sure. But right now, why wait? Now, reach out to somebody that your local bank or somebody like us, and we can help you, point you in the right direction for a refi. So that's it. That's all we have for today. And have a great day, and continue to like and subscribe. We officially passed 1,000 subscribers on our YouTube channel, so we appreciate everyone for sharing us and subscribing. Have a great day.